Welcome to The Explainer. So glad you're joining us today. You know, if you've ever tried to read a mutual fund prospectus, you already know they can be absolute monsters to get through. So today, we're taking on a mission. We are going to break down a very dense 60-plus page scheme information document into something that actually makes sense. We'll strip away all that heavy financial jargon and look straight under the hood at the actual mechanics of a brand new offering. Let's get right into it.
First things first, who's actually behind this product? Well, we are looking at a new fund offer, or NFO, from Kotak Mahindra Asset Management Company. They're obviously a massive player in the Indian mutual fund space, and the document we're unpacking details the birth of a brand new index fund in their lineup.
To make all this dense math totally accessible, we're going to break this down into 5 quick steps. Meet the Kotak Index Fund, where does the money go, the passive strategy, costs, fees, and managers, and finally, understanding the risks.
Section 1. Meet the Kotak Index Fund. Decoding the name. Now, in the finance world, every single word in a product's name is heavily regulated. So let's figure out what the absolute word salad in this fund's name actually means. It tracks the Nifty Alpha Low-Volatility 30 Index. Let's break that down piece by piece. The 30, that means it holds exactly 30 stocks. And these aren't just any random stocks. They are cherry-picked from the top 150 largest, most liquid companies in India, specifically the Nifty 100 and the Nifty Midcap 50. But how exactly are they picked? Well, they look for a combination of alpha, which is basically Wall Street speak for high returns, combined with low volatility, meaning fewer wild, unpredictable price swings. Essentially, this fund is trying to solve that classic investor's dilemma, wanting the aggressive growth of the stock market, but without those stomach-churning drops that keep you up at night.
Moving right along to Section 2. Where does the money go? The asset allocation mechanics.
So now that we know what the engine is, where does your capital, the actual fuel, go once you hit that buy button? Consider the allocation parameters. Almost all your money is locked right into those 30 equity index stocks. By regulation, between 95 and 100% of the fund's assets absolutely must mirror those exact shares. But wait, what about that 0 to 5% in debt or money market instruments? Why not be 100% in stocks all the time? Well, the fund managers need a tiny fraction of cash on hand just for liquidity. Mostly, that's so when investors want to sell their units and cash out, the fund can pay them immediately. They really want to avoid being forced into a fire sale of their underlying stocks on a bad market day.
Section 3. The passive investing strategy. Putting it on cruise control.
How does this fund actually behave out on the open road? The source document explicitly states its strategy revolves entirely around reducing tracking error. So rather than having a hotshot manager wildly guessing which stocks are going to win next week, this fund is strictly passive. Investing here is kind of like putting a car on cruise control using a strictly predetermined GPS map. And in this case, that map is the index.
The operators of this fund are essentially acting as highly skilled mechanics. Their job isn't to beat the market at all. Their job is to flawlessly mirror the benchmark. Step 1, they buy the 30 stocks in the exact weights dictated by the index. Step 2, if the index changes its mind and swaps out a stock, the fund managers have exactly 7 calendar days to rebalance their portfolio to match. And Step 3, which is really the ultimate scorecard for a passive fund, keep the tracking error below 2%. Remember, tracking error is simply the difference between how the underlying index performs and how the fund actually performs. A super low tracking error means the mechanics are doing their job perfectly.
That brings us to Section 4, costs, fees, and managers. What it costs to participate.
Look, every fund costs money to run, and those costs are silently deducted straight from your returns. When you buy into this fund, you basically have a choice of 2 entry doors, the direct plan or the regular plan. The absolutely crucial takeaway here is that the direct plan removes the middleman. If you buy through a broker or a distributor, you're in the regular plan, and a slice of your money goes to pay their ongoing commissions. But if you buy directly from Kotak, you use the direct plan. No commissions are paid out, which means your ongoing costs, also known as the expense ratio, are permanently lower. And trust me, over a 10 or 20-year time frame, that slightly lower fee can compound into a dramatically larger portfolio balance.
Speaking of costs, 1%. The document explicitly caps the maximum estimated total expense ratio, or TER, at exactly 1% of the daily net assets. That is the absolute ceiling they are legally allowed to charge to operate the scheme, pay for audits, custody, and those management fees. Now, because it's a passive fund, the actual daily running costs are typically quite competitive, but this 1% ceiling is locked in by regulation.
But on the flip side of fees, here is a fantastic number for investors to see. NIL. There is a totally zero exit load on this fund. A lot of mutual funds will actually charge you a penalty fee, say 1% of your money, if you try to withdraw your cash within that first year. This fund imposes absolutely no such penalty. You have total liquidity and the freedom to redeem your units and walk away whenever you decide it's the right time.
So, who are the people earning those management fees? It's a team of veteran fund managers over at Kotak. Devinder Singhal and Satish Dandapati oversee the heavy lifting on the equity side, basically making sure those 30 stocks match the index perfectly. Meanwhile, Abhishek Bisson manages that tiny 0 to 5% debt portion we talked about, just ensuring the fund always has the safe, liquid cash it needs to operate smoothly day to day.
Finally, Section 5. Understanding the risks, the sobering reality.
All right, it's time to look at the exhaust of this machine. The regulator requires riskometers to be placed front and center in the filings, and they explicitly warn that both the fund itself and its underlying benchmark sit firmly in the red, very high-risk category. Because this fund invests almost entirely in the stock market, you have to remember your principal investment is completely exposed to market crashes, economic downturns, and global panics.
And we aren't just talking about general market dips either. We have to consider some very specific threats. For instance, there is tracking error risk. The fund might just fail to effectively mimic the index during periods of extreme volatility. There's liquidity risk. If the market completely freezes, the fund might have trouble actually selling those stocks. But perhaps the most vital thing to understand here is the concentration risk. According to the document's own rules, just the top 3 stocks in this index can cumulatively hold up to an incredible 65% of the total weight. Think about that. If just one of those 3 giant companies has a terrible year, it is going to heavily drag down your entire investment, regardless of how well the other 27 companies happen to be doing.
So, we've broken down the engine, the fuel, the costs, and the risks. This explainer gives you the objective mechanics drawn straight from that massive 60-page document. But it definitely leaves us with a fascinating contradiction to ponder. Can a fund specifically named low volatility truly protect your peace of mind when just 3 companies can control 65% of your investment? Does this specific blend of high-growth ambition and highly concentrated risk actually fit your personal financial journey? Only you can decide. Thanks so much for joining me on this explainer.